Welcome to Section 4 of the PNJ Group Income Statement Training Series. Today we go inside the income tax line, one line on the face that conceals significant complexity, and examine how tax is allocated across the components of income and equity. By the end of this section, you will understand current versus deferred tax expense, the ETR reconciliation requirement, what intraperiod tax allocation is and why it matters, how to apply the correct allocation sequence, and what a negative ETR is signaling. There is a standing temptation to treat the income tax line as a black box, one number, move on. That is a mistake. Behind that single line sit two distinct components: current tax expense, which is the amount actually owed to tax authorities for the period, and deferred tax expense, which represents the change in deferred tax assets and liabilities. A SC 740-1059 requires a breakdown of both in the notes, split by current versus deferred and by jurisdiction, federal, state, and foreign. Public companies go further. They must reconcile their effective tax rate to the statutory rate. Current tax expense is straightforward. It is the tax bill for this period, computed on taxable income under the tax code. Deferred tax expense is more nuanced. It reflects the net change in deferred tax assets and liabilities during the period. A deferred tax liability arises when book income exceeds taxable income today, meaning more tax will be owed in the future. A deferred tax asset arises when taxable income exceeds book income today, meaning future taxable income will be reduced. Together, current and deferred components add up to total income tax expense on the income statement. The ETR, effective tax rate, is income tax expense divided by income before taxes. It tells you, at a glance, whether the tax burden is in a range that makes sense given the entity's operations and jurisdictions. For public companies, U.S. GAAP requires a rate reconciliation in the notes, walking from the federal statutory rate to the actual ETR. Common reconciling items include state taxes, permanent differences like non-deductible expenses or non-taxable income, R&D tax credits, and valuation allowances on deferred tax assets. An ETR that sits far from the statutory rate is a signal, not a curiosity, that demands investigation and documentation before financial statements are issued. Intraperiod tax allocation sounds technical, but the logic is intuitive. Imagine a year where continuing operations breaks even but a large unrealized gain on available-for-sale securities flows through OCI, other comprehensive income. Without allocation, the OCI line would show the full pre-tax gain while the tax line would show zero expense, because total income is zero. That distorts both components. Intraperiod tax allocation prevents this by assigning the tax effect to the component that generated it. A SC 740-20 governs the mechanics across four areas: continuing operations, discontinued operations, OCI, and items charged directly to equity. Here is where the most common error in intraperiod allocation occurs. It feels intuitive to compute the tax on continuing operations directly. Take pre-tax income from continuing operations and multiply by the ETR. That is wrong. The correct approach under a SC 740-20 is sequential. First, compute total income tax for the period. Then allocate the tax effects to discontinued operations, OCI items, and equity items, each based on their own facts. Whatever is left over, the residual flows to continuing operations. This is called the with and without method. Applying a flat rate to each line item independently produces incorrect allocation and must be avoided. Two areas receive especially close attention in intraperiod allocation. Discontinued operations are presented net of their own tax effect on the face of the income statement. The tax amount is then disclosed separately in the notes, so users can see both the gross income and the tax. OCI components follow the same logic. Each item is presented net of tax. The three most common OCI items: the CTA, Cumulative Translation Adjustment on Foreign Operations, unrealized gains and losses on a FS, available for sale, securities, and pension obligation adjustments, all appear net of their respective tax effects in the Statement of Comprehensive Income. Not all tax effects pass through income tax expense on the income statement. Some go directly to equity. Excess tax benefits or deficiencies from stock-based compensation under a SC 718, the difference between the tax deduction at vesting and the expense recognized over the vesting period, are recorded in a PIC, additional paid-in capital. Tax effects of treasury stock transactions similarly flow to equity. And when a prior period error is corrected, the tax effect of the correction rides with the error to retained earnings, not through the current year's tax line. These equity root tax items are a common source of confusion in the preparation of income tax provision schedules. A negative ETR is disorienting. It means the entity is recording a tax benefit in a profitable year or recording a tax expense in a loss year. This is not necessarily an error, but it always requires investigation. The most common causes are permanent differences. Non-deductible expenses increase the effective rate, while non-taxable income decreases it. Valuation allowances on deferred tax assets can flip the sign if a large allowance is established against deferred assets. Tax credits, particularly R&D credits, reduce tax expense sometimes below zero relative to pre-tax income. Discrete period items like resolving an uncertain tax position can also distort the rate in a single period. The rule is simple: always investigate, always document before statements go out. Let us close with the essentials. Income tax expense is a single line on the face but contains two components, current and deferred, that must be broken out in the notes. Public companies reconcile the ETR to the statutory rate, and the gap in that reconciliation tells the real story of permanent differences, credits, and valuation allowances. Intraperiod tax allocation ensures each component of income and equity carries its own tax effect, preventing distortion. The most important mechanical point: continuing operations is the residual in the allocation sequence, not a direct ETR calculation. OCI items and discontinued operations are net of tax. Stock compensation and treasury stock tax effects go directly to equity. And anytime the ETR behaves unexpectedly, investigate before issuing. Thank you for completing this section on tax expense and intraperiod allocation.